Hey everyone, this is another video of Small Business Treasury. I want to talk about a very important topic today that is crucial for the small business owner and founder who is growing their business, who's building momentum, who has very good revenue coming in, they have good net profits, they have good margins, and then we're going to focus on the importance of treasury controls, right? So that is one of the most important topics when it comes to treasury, which is protecting the capital that you've worked very hard to earn, right? That's one of the most important things when it comes to growing your business, because you're building momentum, you see money coming into your bank account, you're fulfilling projects, you're fulfilling um, good services with your clients. You want to make sure that when that money comes in, you're protecting it at all costs. And this is a mistake that I've seen many small businesses make. And it's one of the first things that I teach when people come to me and ask me for general treasury advice and what is the things that I recommend that they one of the first things that implement as a protection when it comes to their treasury function, right? So the topic of today's video is why banking structures matter, right? So as we discussed in the past, treasury, one of the main important aspects of treasury is protecting the capital that sits in the bank. And when it comes to large corporations, we have multiple procedures in place to make sure that, that capital is protected. But the small business owner or the founder who's growing their company, they don't really think about these things until something happens. And I want to encourage individuals to always be proactive and not reactive when it comes to protecting the capital that you worked so hard to obtain. So the biggest mistake is that many individuals or small businesses, they treat their banking checking account like a personal checking account. And that's very dangerous when it comes to your organization, because as you have more employees, more transactions, more fraud risk, more operational complexity, you are at risk that something may go wrong, or that some of the cash that you worked very hard to obtain may start to slowly bleed out that aren't legitimate transactions. And many times people think that growing businesses are at risk to external factors, which that is true. But one of the biggest risks when it comes to small businesses, and I've been in this position, is that they are weak, they're most vulnerable internally. Because when you hire an individual, when you hire your first staff accountant, when you hire your first head of finance, when you hire your first head of accounting, your first CFO, whatever it may be, or you may already have a team of staff accountants, you have a CFO, and you're trusting this individual who leads your finance and accounting department to be ethical and moral in your business. And as much as we want to believe that is the case with people, it's not always the case with everyone. And it's not about assuming that the people that work for you are ethically bad, but you're just protecting the cash by having systems in place, by having checks and balances available to make sure that there's no single point of failure when it comes to protecting your cash. So the the main point of what I'm describing here is a single person control problem. As I've mentioned in previous videos, when you have a growing company, you have your first 10, 15 employees, you've hired a CFO, you've hired a staff accountant, the many times the most vulnerable position that will be is that that individual has control and full control and visibility of the banking portal, and that individual is capable of sending transactions outside of your business checking account without someone else approving or releasing those transactions. That is the most critical and most vulnerable for a growing business. I've seen this happen multiple times. A small business, they're generating a couple 100,000, they're generating a couple million a year, and then they hire a CFO, and then they come and they're trusting that the CFO is going to operate in a good way, and then the CFO realizes that they are in complete control of all of the banking transactions, all the cash in that account without someone else holding them accountable. That's a very dangerous position to be in, because if your business is generating hundreds of thousands a month and the CFO or the head of accounting or whoever that staff accountant is the person who has complete control of the bank accounts, they are able to quote unquote send transactions to either their personal account, which many times they don't do it to the personal account, but they can send it to offshore accounts. They can send them to international accounts. They can send them to fake companies. They can send them to non-traceable accounts, right? So many times what ends up happening is I have a story where this happened to a very close friend of mine. He was describing that he was growing. He was working at a small business. They were growing. They were making a couple million a year. They hired a head of accounting, or in this case, they acted as a CFO. And this individual had complete control of the checking account. And in most checking accounts in small businesses, they have the ability to send Zelle. So what was happening is that the CFO was recognizing that the business was operating just, with low controls. Nobody really was holding accountable. He can log into the banking portal. He was recognizing that it was very easy for him to send money from that account. So over time, it was discovered that this individual was sending cash to a foreign account. He was embezzling money. And that is an example of the single point of failure, or the single person control. So you as a founder, you as a CEO, you're recognizing that you didn't implement dual approval controls in your banking portal, and now you're at risk of someone within your organization to be able to send cash out of your checking account without you being aware. That is very, very, very important for a treasury control. You as a CEO are responsible for the actions of what happens inside your organization. You need to be aware of these types of treasury controls to make sure that you are preventing fraud from happening, preventing embezzlement. You are preventing uh, people stealing from you. How many times have we seen billionaires talk about their stories about how they learned this lesson the hard way? One of those, you could look at the stories of some individuals from Shark Tank. They lost $60,000 because one of their employees was able to send money out of the checking account without dual approval, and that is a treasury risk. That is not having the proper protocols in place to make sure that doesn't happen. So as the founder, CEO, the executive team member, it is your responsibility to make sure that you have these uh, processes in place. You have to remember, a CFO may have a lot of experience when it comes to managing large corporations, or maybe they've had a very good upper management experience, and you've hired them as a CFO. A CFO is not a treasurer. A treasurer is responsible to make sure that these things are in place. A CFO is an individual who sits above the treasurer, or and many times sits horizontal to the treasurer. So the CFO is looking to the treasurer to implement these things. Many times, some CFOs may not have this type of experience to implement it into the organization, especially if they're not a seasoned CFO. So if you hire an upper management accounting individual and they don't have heavy CFO experience, they're not going to know the functions of implementing the treasury procedures and protocols when it comes to protecting the dual controls in the banking portal. That is your responsibility as the executive team member to make sure that you have these processes and protocols in place, and then you delegate the execution of that implementation to the CFO, and then he implements that, or you delegate that to your treasury individual, your CFO, your accounting individual, In small businesses, they're all kind of lumped into one. You want to make it into a habit of trying to create separate divisions as much as it's as clear as possible. But early on, if they're all lumped into one, you have to delegate that implementation to your head of accounting, your head of finance, your CFO, and make sure that they are implementing dual approval controls with the banks. They have to go to the bank. You as the founder, the account signer, and the CEO have to sign off on these treasury implementation protocols with your uh, with your banker, but the CFO is usually the one who implements and leads that project. But it's your responsibility to make sure that it's implemented. So unless the CFO comes to you and says they need to implement it, sometimes they will, sometimes they won't. At the end of the day, the responsibility falls on you. You don't want allowed to uh, an embezzlement to happen and then you implement it. You want to implement it before you even hire the CFO or the head of accounting. You want to have these processes in place. If it's a growing company and you hire a CFO, you want to make sure that they have one of the approval rights and then you have the other approval rights. So you as a founder, the CEO, the executive team member are aware of every transaction that is leaving the business checking account. So that is the importance of the single person control. And then the other part of that is the lack of payment approval controls, right? So that's very similar to what I kind of just mentioned, that every transaction that leaves your checking account, you want to be at least an approval of that transaction, right? Like I mentioned in the story that happened in one of my friends, you could call them, uh, growing company, there was one person who was able to sign off and send ACHs and wires. It's very easy to embezzle money at that point. The CEO, the founder, he's so busy trying to grow the company, trying to implement these new strategies, trying to grow the company, trying to raise capital from investors, trying to go to the banks to finance the company through debts and debt issuance, that they're not aware that they are at risk from having one individual point of failure by not being in dual controls within the organization. Uh, some people may ask, can you have dual approval with two members of the accounting team? Yes, you can, but as a growing organization, it is highly advised and recommended that you, as the CEO or founder, or at least in the approval process for those transactions, especially for very large transactions of 50, 60, 70, $80,000 ACHs or wires. You as a founder, CEO, to ensure that you're protecting your capital, you want to be an individual who signs off on one of those transactions. Don't just delegate the entire thing to your accounting team. As your company grows and you develop a C-suite and you develop a board of directors, sure, you can delegate that to the CFO and the treasurer or the controller or another individual. But in the beginning stages, in the first couple million, you want to at least be participating in that, or at least be aware through some sort of email communication of every ACH transaction and wire that goes out, especially in those in the five figures or more, 10,000, 20, 30, 40,000, right? So uh, another form of uh, treasury risk is not having separation of duties and roles. In other words, having segregation of duties, right? So in corporate treasury, I'll give you an example how a corporate treasury team functions. You usually have 2 to 3 people sign off on a transaction. You have the analyst, the junior analyst, or the senior analyst who initiates or creates the payment. Then you have the manager who approves the payment. And once the manager approves the payment, the analyst, the senior analyst may release the payment, right? And the reason why that's very, very important is that whenever you are dealing with the segregation of duties between individuals, each time you sign off on a transaction, you leave a digital fingerprint or a digital signature for that transaction. So that signature allows the bank to recognize that there is a segregation of duties when it comes to payment processing and proper treasury procedures, right? So in a growing company, ideally, it should be the CFO initiates a transaction or the head of accounting, the founder, CEO, approves it, and then the individual releases it, right? So there's a segregation of duties. There's always a dual control, person one and person two. And that is very important when it comes to just making sure that proper internal protocols are in place to ensure that no one has the ability to send transactions at their own will without the knowledge and approval of someone in the executive team, right? So segregation of duties is very, very important, and we can make a whole video just on that, and I'll probably do that in the future because segregation of duty goes beyond just submitting a payment and having an approval. It goes into many, many parts of the treasury function. A treasury team always has multiple team members signing off on multiple tasks, especially tasks within the banking portal. Another example would be many times growing companies and almost every single banking portal has the ability to create um, vendor templates. So let's say you have a vendor that you pay repeatedly on a monthly basis. An example would be your landlord. If you are able to create templates that happen recurring every single month, an example of segregation of duties is that the analyst or someone else on your team creates the template, and then it's approved by the manager or the C-suite individual, or in this case, particular the founder, the CEO. They approve it to make sure that even templates that have a recurring transaction on a monthly basis, that they're not being implemented with false banking information or false banking entities, making sure that the individuals who submit the template is approved by manager or a C-suite individual or the CEO or founder, right? So that is another example of segregation of duties. It's not just submitting a payment and releasing. It also applies to wire templates, ACH templates, payments, positive pay files, check files, and anything related to the treasury function within the banking portal. So another part of that, of the importance of segregation of duties, is the lack of bank account visibility. So one of the things that I've noticed in growing businesses and founders, if they're asked how many bank accounts do they have, who has access to those accounts, which users are active, and if they're asked those questions, they're not able to give a solid answer, they have no visibility of what's happening inside their banking platform. And that is a huge problem, because one of the most important questions to that is which users are active. Let's say you're a growing company, you hired a couple accountants, some of them resigned, and they had access to the banking portal. Well, they resigned, they no longer work for your company, but they're still active in the banking portal. That is a huge risk to your business, because even though they're no longer employed, if they still have access to the banking portal, they can still log in, see the activity that's happening. And even worse, if there's not dual approvals, they can log in, take money out through some sort of ACH transaction or Zelle transaction, and then they can send it to a foreign account, international account, where it's non-traceable. And all of a sudden, you don't even know who initiated that transaction, right? So, or why they even had access to begin with, if they're no longer working with the company. And now, instead of growing your business, you're fighting legal battles trying to recover that money. You're hiring lawyers. You're trying to make payroll because they embezzled $50,000, right? These are all problems that happen because you don't have the proper treasury controls in place to prevent things from happening in your business. You want to be proactive in the treasury function, not reactive. That is one of the most important aspects when it comes to bank visibility, and making sure you have an up-to-date, you know, uh, audit of all of the banking activity happening in your organization. You have to request that from the CFO, that you demand to see a monthly audit of how many bank accounts are active, who has access, what are their user access entitlements, and then what users are active that are no longer within the company, right? So those are very, very, very important things that you want to be able to, as a CEO and founder, be responsible to have visibility within your banking platform. I have so many stories that I can tell about that from a corporate treasury standpoint. Super important. Like I've mentioned several times now, treasury is not an exciting topic. It's not something that makes people excited, but is very important when it comes to protecting the cash and the capital of the money that you've earned, you worked so hard to earn. You don't want to be spending time on chasing individuals and fighting legal battles and trying to recover cash. That those are things that you should be focused on growing your business. And if you have the proper treasury protocols in place in the beginning, you don't have to be worrying about that as your company grows. I'll give one last example. Many individuals and founders are not aware the difference between ACH and a wire. If at any point in your organization, if you have a single individual who is able to send wires from your bank account, I'm telling you right now, wires are not recoverable. If they send cash via wire to a foreign international account, you are not recovering that capital. It's not happening. Very unlikely. Even multi-billion-dollar organizations who have been victims of fraud through wires spend millions of dollars trying to recover cash that was sent through a wire. Not happening. A wire is irreversible. You cannot recover. Once the bank releases it from your account, very unlikely for you to recover it. That's why wire fraud is one of the most important aspects in or targets for growing companies. And wire fraud prevention is one of the most important topics that you as a founder, CEO, C-suite to implement in your treasury organization, your treasury department within your organization. Because a wire you cannot recover. Even billion-dollar companies attempt to acquire wires. It's not happening, especially if it's an international foreign account. You're not going to be able to recover those funds, because once the cash leaves the United States, the banking officers do not have jurisdiction to the bank that the money goes to. So we'll talk about that in another video, the importance of wire fraud and how to prevent it, and why it's important for a growing company, and why it's important to have that as a treasury protocol. But yes, that is one of the most important things. I've seen it happen multiple times. Even billion-dollar organizations are victims to that, and small businesses are even more victim to it because they don't have the proper treasury functions in place. That's all for today's video, and we'll see you next time.